Today, topic 9 starts, and topic 9 will deal with something called closing entries. And I've been hinting at this for a while now. When we had problems, I told you that accounts like revenue and expense have zero balances at the beginning of an accounting period, at the beginning of a particular problem that I assigned. And I said, eventually we're going to explain why that is and how that happens, and that time is here. So that's topic 9, something called closing entries. On your screen, let's look at 4 steps that every accountant needs to do at the end of the accounting period. As you know, accounting periods vary. Could be a month, could be 6 months, could be a year, but whatever works best for a business is what they use. But at the end of that accounting period, 4 steps need to be made, and you've had most of these already. Step number 1, we need to calculate and record the cost of goods sold. That was what we did in topic 7. We did a lot of that. Topic 8, we just finished, talked about depreciation. Depreciation of major assets. These were things that last a long time, are expensive, and decline in value. We talked about how businesses handle those assets that decline in value. And then we constructed financial statements, income statement, and balance sheet. There are other financial statements, but we are centering on those 2. Then, number 4 is what topic 9 will get into. The last step is to record the 3 closing entries. There are 3 of them to update the balance in the owner's equity account. And we will talk about that in topic 9 and with this example today. So let's look at a problem that you had recently, and we begin with our journal. We have the XYZ company. If you remember, you did this just recently. I gave you a number of entries that were journalized and then posted to the ledger. Then you had to add some as well. At the bottom, you had to, first of all, journalize and post the payroll entry. If you remember, that's this entry, and that goes all the way back to topic 6 in the first semester. Hopefully you remembered how that works. Then you had to do another entry, in this case, the cost of goods sold expense entry. You had to figure out what that cost of goods sold would be, and I gave you some mathematic arithmetic things here to show you how that works using the LIFO, last in, first out method. So that was topic 7. Then topic 8, we used depreciation, and you had to enter a transaction that accomplished the depreciation expense on the new computers that we bought. This is based on information given to you on the right, and you calculated that the monthly depreciation for these computers was $250. So you had to journalize and you had to post those 3 entries. Now I'm going to add 3 more at the very end that need to be done at the end of an accounting period. This will deal with accounts that need to be closed, and there are actually 3 different kinds of accounts that need to be closed. First one is sales, and what we will be doing is, and I'll explain why we do this after we get all this journalized and posted. Hopefully it will become clearer to you why we do this. But we first of all have to make the sales account, the revenue account, have a 0 balance, and that closes it. Any account with a 0 balance is called closed. Now, sales has a credit balance. If we looked in our revenue, sales has a credit balance right now of $31,800. So to close it, I need a debit in the journal, and that's what I do, $31,800. And when I do this in our books, we need to always follow generally accepted accounting principles, which means debits have to equal credits. So if I debit sales, I got to credit something. What I credit is this temporary account. Income summary is a very temporary account that we use right now and no other time, actually. But in this case, it will be credited by the $31,800. So let's quickly look at how this would look. if I journalize this and then I post it, and if I debit 31.8, our balance should be 0. So I've taken money out of sales, literally closed it, and I have to put it someplace, and I put it in this account called Income Summary. This is found in the same area as the owner's equity. This is a temporary account, and if I debited sales, then I need to credit Income Summary. It now has a credit balance. It's very temporary, but that's where it is right now. And that is account number 302. So back in our journals, I think sales was 401. This is 302. So we've closed sales. We've taken money out of sales, put it temporarily into this Income Summary account. So sales now has a 0 balance. The next closing entry is to close 3 expense accounts. Now, this company just has 3. There could be any number of expense accounts, could be 5, 10, or more, but this has only 3. So we need to close them. All expense accounts have a debit balance right now, and let's start with the 3 credits. Let's look at our expense accounts. In order to close depreciation expense for computers, we need to credit $250. Why do we credit $250? Because if I look at that account, depreciation expense for computers, it has a debit balance of $250. So I will credit $250, and that closes it. I'm taking the money out of this account, making it have a 0 balance. That's account 501, and that goes into our journal. Next expense, expense is salaries expense. If I look at that, it has a debit balance of $15,000. And again, from journal page 15, and I will credit, as we just saw in the journal, by $15,000. That has now a 0 balance. That's account 502, back into the journal. And the third and final one, our cost of goods sold expense. Like any expense, it has a debit balance. So I will close it with a credit. Of $14,140. And that has a 0 balance now. That account number is 503, and that goes into our journal. So we've closed these 3 accounts. They now have 0 balances. I need to have a debit because 3 credits can't stand by themselves. Debits have to equal credits. And again, I use this temporary account. Once again, Income Summary. And the $29,390 is simply the total of these 3. If I add them up, I'll get $29,390. So I need to debit Income Summary by $29,390. So let's go back to this temporary account. J15, and I debit $29,390. And I have now a credit balance here in Income Summary. So that might look familiar because if you remember on the financial statement, there's a 2410. We'll come back and explain why that makes sense in just a moment or two. So we have taken literally the money out of sales and put it into Income Summary. We've literally taken the money out of the 3 expense accounts and put that total of those 3 expenses into Income Summary, and we now have a credit balance of 2410. Then we go back to our journal and look at the last closing entry. The last closing entry will close Income Summary. As I said, it's very temporary. So now we've put money into it. Now we're going to take money out of it. And we debit 2410 because that will close it. So if I go to the account, J15, and if I debit 2410, that closes the account. So now we've opened it, now we've closed it. But the money has to go someplace. This happens to be 302. And I didn't put it up here. I should have put it up there too in our last entry. So 302 into the journal, and the debit in the income summary closes it. And now we use owner's equity. Owner's equity is the account that gets credited by 2410. So when I go here, I credit 2410. That doesn't close owner's equity. That does not get closed. But look what happened to the balance. Lo and behold, $64,535 is the same as our balance sheet that you figured using the accounting equation. That's how we reconcile the two. We literally have made this number and the balance of owner's equity agree. And it makes sense because if you're thinking like an accountant, hopefully by now you're beginning to think that way. When we have the end of the accounting period and we make an income statement and we make a balance sheet, we've indicated that we have a net income. The company, the XYZ company, made some money. They made $2,410, and that ought to increase the value of the business. Where do you show the value of a business? You show it in the owner's equity account. So in our owner's equity account, we started at the end of January with a credit balance of $62,125. That was the value. Now we've made some income during the month of February, and by following generally accepted accounting principles, by going through our journal and our ledger, we have closed those expense accounts, we've closed the revenue account, and the income, the net income that we've shown on our income statement of 2410 is credited in the end to owner's equity, which increases the value of owner's equity. Now, if we had a loss, if we lost money during the month, it would end up, if you follow this through, it would have ended up with a debit over here, which would have reduced the value of the business, the owner's equity. But we made money, so it is credited and added to our owner's equity account. And this was account 301. And we've done our 3 closing entries. So the closing process literally takes the money out of sales, which is the revenue account, and put it into income summary. We then take all the money from the expenses, we close the 3 expenses, put that total into income summary. Our 3rd closing entry, we're literally close that temporary account called income summary into owner's equity. Owner's equity is increased, in this case by 2410, which happens to be, and it should be, our net income. This is the essence of topic 9. We have just 3 entries to do in the problems that you'll have, and in each case, they're done the same way. So we close the revenue accounts, we close the expense accounts, and all that money ends up going to the owner's equity account. So all of our accounts now, the ending balance in all of our accounts should agree with all these numbers on the income statement and all these numbers on the balance sheet. So the owner can see a true picture of the value of the business and how the business did during this accounting period. If you need to, go back, review this because it's an important concept, and then go to your course page and answer the questions that follow.